Okay, now we will talk about the first step. You got to be able to find all related cash flow, right? Which is initial outlay, the annual free cash flow, and the terminal value. So you need to identify incremental cash flow, right? What incremental cash flow refers to additional cash flow generated by a new project. So it equals to the firm cash flow with the project minus the firm cash flow without the project. So with or without the project, what difference does it make in terms of cash? So we will mention only incremental cash flow in this chapter, all right, with or without the project. We don't take sunk costs into the calculation. What is sunk cost? The sunk costs are the costs that have already been incurred or are going to be incurred, regardless of whether or not the investment is undertaken. Just like what? The cost of business research, right? Marketing research. You need to do this anyway, right? No matter you want to accept or reject the project, you need to pay for the marketing research. And you need to look for the synergy effect, right? Synergy effect can be positive or negative. Like what? It can be positive. For example, if you are the theater, you major cineplex, right? And then you decide to bring the new movie to the major cineplex. The major revenue supposed to be the ticket sales, right? And what should be the synergy effect for this? Synergy effect could be what? Once the people come to see the movie, they will also see what? The introduction or the commercial for new movies, right? So this can be positive effect or positive synergy. What about negative synergy effect? Just like you are the phone shop, right? You want to, right now you're selling, let's assume iPhone 5, and the cost is 20,000. And you thinking about the new project to bring iPhone 6 to the shop, right? And iPhone 6, let's assume the same cost, 20,000. Once you bring iPhone 6 to your shop, can you still sell your iPhone 5 for 20,000? No, right? You need to reduce the price of iPhone 5. And that is the negative synergy effect for iPhone 6 project. And opportunity cost, you need to incur into capital budgeting, right? What is it? It's the cost of passing up the next best choice when making a decision. Just like if you use your own house to do coffee shop, it doesn't mean, I know you don't need to pay rent, right? But you lose opportunity to use your house to do something else. And that should be opportunity cost that you should incur into the capital budgeting. And we should ignore interest payment and other financing costs, like what? Interest expense, right? When you calculate free cash flow, you don't need to take interest and deduct with the EBIT, right? Because since we got free cash flow, we need to discount by interest anyway, right? So we will avoid double counting, okay?